Hey, welcome back to Compounding Quietly. A high yield is not a reward. It is often a warning sign in disguise. The number that looks the most attractive on a screener is frequently the one that's lying to you. Most investors see a big yield percentage and assume bigger automatically means better. But what if the number you should actually be watching isn't the yield at all? Let's actually look at this clearly. Every dividend investor eventually faces the same screen, the same spreadsheet, the same decision. One stock yields 6%, another yields 2%. The instinct is obvious. Chase the bigger number, lock in more income today. But that instinct is exactly where most income investors quietly go wrong. A 6% yield that never grows is a fixed number in a world that never stays fixed. Prices rise every year, sometimes slowly, sometimes sharply, but always in one direction over time. A static income stream loses ground to that rise a little more each year, even if the number on the statement never changes. This isn't a market prediction. It's just arithmetic playing out over a long enough timeline. What matters here is not which number looks bigger on day one. It is which number is designed to keep up with where you'll be in 10 years. That's the real criteria, and it's the one most yield comparisons completely skip. Picture an investor scrolling through a stock screener, sorting by yield, high to low. The top results all share something in common. Most of them got there by standing still while their share price fell. A falling price pushes yield up mathematically, even when nothing about the business actually improved. That's the trap. The yield went up, but the reason it went up should make you more cautious, not more excited. So let's separate the two numbers that actually matter here, because they are not the same thing wearing different names. Yield tells you what you'd collect today if you bought at today's price. Dividend growth rate tells you something completely different, how fast that payment has been increasing year over year. One is a snapshot, the other is a trend line. And trend lines are what compound, not snapshots. Consider two companies side by side, because this is where the difference actually becomes visible. Company A pays a 4% yield today and has raised that payment by roughly 3% a year, consistently, for over a decade. Company B pays a 7% yield today, but the payment has barely moved in 5 years, and it was cut once during a rough quarter. On day one, Company B looks like the obvious winner. Stretch that comparison across 15 years, and the picture flips entirely. Company A's income stream, growing steadily, eventually surpasses what Company B ever paid out, while carrying far less risk of another cut. This is the part most yield-chasing investors never sit with long enough to notice. They're optimizing for the first year of a decision that's supposed to last 15. Coming back to the original question, which number matters more, yield or growth rate? The honest answer depends entirely on which phase of investing you're actually in. If you're still accumulating, still years away from needing, the income, growth rate, deserves far more weight than the yield sitting in front of you today. You're not buying this year's check. You're buying the trajectory of every check that follows it. If you're closer to relying on that income now, yield understandably carries more immediate weight. But even then, a growth rate near zero should raise a flag, not get waved off. An income stream that doesn't grow is quietly losing purchasing power every single year it stays flat, even if the dollar figure never drops. That's the judgment this comes down to. Not which number is bigger, but which number tells you what happens 5 years from now, not just what happens this afternoon. There's another layer to this that rarely gets mentioned directly. The market consistently rewards businesses that grow their dividend, with more stability during downturns than businesses offering the highest yield available. A company raising its payment every year, even modestly, is signaling something about its underlying cash flow that a flat or shrinking payment cannot signal. That doesn't mean high-yield investments are inherently bad. Some serve a real purpose for investors who need income right now and can tolerate less growth. But calling a high yield safer simply because the number is bigger gets the logic backwards. Yield is a snapshot of price and current payment. It says almost nothing about whether that payment will still be there, let alone larger, several years from now. By the time most investors are 5 or 6 years into a strategy, they've usually figured this out the hard way, often after a dividend cut they didn't see coming. The fix isn't complicated, but it does require resisting the screener's default sort order. Look at the growth rate first. Ask whether that growth has been consistent, not just present in one strong year. Then, and only then, look at where the current yield sits relative to that growth. A modest yield paired with reliable growth will almost always outperform a flashy yield paired with stagnation, given enough time for compounding to actually work. The market doesn't hand you certainty before you commit to a number. It hands you a track record, and it hands you a trend line. The yield is what the business is paying right now. The growth rate is what the business has proven it's capable of, repeatedly, over time. One of those numbers tells you about today. The other tells you about the next decade. The criteria don't change with the market. That's the whole point. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.